The Rise and Fall of Empires, 5 Financial Bubbles that Shook the World. Could the rapid ascent of artificial intelligence, with its dizzying valuations and transformative promises, be the next great financial bubble? It's a question that echoes through every generation, a timeless uncertainty faced by those living through periods of unprecedented technological or economic change. No one can definitively answer it, for history does not offer a crystal ball. But history can show us what a bubble looks like from the inside: the euphoria, the irrational exuberance, and the inevitable painful burst. Today we journey back through time to explore 5 of the most catastrophic financial bubbles, moments where collective speculation defied economic gravity, only to succumb to its immutable laws. From the nascent financial markets of 17th-century Holland to the digital boom of the late 20th century, these are the stories of fortunes made and lost, of economic systems pushed to their breaking point. Let us begin our countdown, not with predictions, but with the undeniable lessons of the past. Number 5. The Mississippi Bubble, 1719 to 1720. Our journey begins in early 18th century France, a kingdom burdened by immense debt following the wars of Louis XIV. Enter John Law, a Scottish financier and gambler who proposed a radical solution: replace metallic currency with paper money issued by a state bank. In 1717, Law's Compagnie d'Occident, later renamed the Compagnie des Indes, was granted exclusive trading rights to France's vast Louisiana territories. Law skillfully linked the company's shares to his bank's notes, creating a powerful feedback loop. The vision he painted of Louisiana was one of untold riches: gold, silver, furs, a veritable paradise of economic opportunity. As documented by historian François Crouzet in Britain, France, and Economic Growth, 1680-1880, public enthusiasm soared. Shares, initially priced at 500 livres, skyrocketed to 10,000 livres by December 1719, creating instant millionaires and widespread speculative fervor. The Rue Quincampoix, where shares were traded, became a scene of frenzied activity, packed with nobles, commoners, and adventurers. However, the Mississippi Company's actual profits never materialized to justify such valuations. As investor doubts grew, particularly concerning the true value of Louisiana and the bank's ability to maintain the paper currency's convertibility, the bubble began to deflate. By May 1720, a rush to convert paper money into specie, silver and gold, overwhelmed the bank. The government's attempts to prop up the value of shares and notes through various decrees only intensified the panic. According to financial historian Charles Kindleberger, the Mississippi bubble's collapse resulted in a complete loss for many investors. It left a lasting scar on French finance, instilling a deep suspicion of paper money and stock markets that hampered France's economic development for decades. Number 4. The South Sea Bubble, 1720. Across the English Channel, almost concurrently, another equally spectacular bubble was inflating. The South Sea Company, founded in 1711, promised immense wealth through exclusive trading rights to Spanish South America. England was also grappling with substantial national debt, much of it from the War of the Spanish Succession. The South Sea Company offered to convert this national debt into its own shares, creating an irresistible opportunity for investors. As recounted by Edward Chancellor in The Bubble and Beyond, the allure of the South Sea trade, despite Spain's actual reluctance to open its markets, was potent. The company's stock, initially around £128 in January 1720, disparut para mais de teens no início de agosto. This period saw a proliferation of bubble companies, many with outlandish schemes, piggybacking on the speculative mania. One such proposal was a company for carrying on an undertaking of great advantage, but nobody to know what it is. Even Sir Isaac Newton, the scientific giant, was caught in the frenzy. After initially selling his shares for a profit of £7,000, he re-entered the market at the peak, losing £20,000. Newton famously remarked, "I can calculate the motions of heavenly bodies, but not the madness of people." The bubble burst swiftly in August 1720 as confidence evaporated and panicked selling ensued. Parliament launched investigations, revealing widespread fraud and corruption among company directors and even government ministers. The South Sea bubble devastated thousands of investors and damaged public trust in financial institutions for generations. Number 3. Tulipmania, 1637. Our journey now takes us further back in time to the Dutch Golden Age, where a seemingly innocuous flower became the catalyst for the world's first recorded speculative bubble. Tulips, introduced to Europe from Turkey in the late 16th century, quickly became a status symbol in the affluent Dutch Republic. Their vibrant colors and unique patterns, particularly those caused by a mosaic virus, made them highly desirable. Initially, the trade was limited to botanists and wealthy enthusiasts. However, by the 1630s, the market transformed into a speculative frenzy, with futures contracts for bulbs being traded. As recounted by Mike Dash in Tulipomania, the story of the world's most coveted flower, ordinary citizens began to invest, mortgaging homes and businesses to acquire bulbs. The price of some rare tulip varieties skyrocketed. In February 1637, a single Semper Augustus bulb reportedly traded for 6,000 guilders, roughly the cost of a grand house on an Amsterdam canal. Another famous transaction involved a bulb exchanging hands for 8 fat pigs, 12 fat sheep, 2 hogsheads of wine, 4 barrels of beer, 2 barrels of butter, 1,000 pounds of cheese, a complete bed, a suit of clothes, and a silver drinking cup. This was not a trade in commodities, it was a pure speculation on the greater fool theory, the belief that someone else would pay even more. The bubble burst abruptly in February 1637 when buyers simply disappeared. Prices plummeted, leaving thousands bankrupt and devastated. The consequences were swift and severe, plunging many Dutch towns into economic distress. Although the overall impact on the Dutch economy was not as devastating as some later bubbles, Tulipmania remains a potent symbol of irrational exuberance. Number 2. The Wall Street Crash, 1929. Our next bubble brings us to the Roaring Twenties in America. A decade of unprecedented prosperity and optimism. The stock market became a playground for ordinary Americans who saw a seemingly endless upward trajectory in share prices. Key to this boom was the practice of buying on margin, where investors purchased stocks with borrowed money, often as little as 10% down. This amplified both potential gains and, critically, potential losses. As documented by historian Robert Sobel in The Great Bull Market, Wall Street in the 1920s, the Dow Jones Industrial Average soared from 63 in 1921 to 381 in September 1929. Corporate profits were strong, but the valuation of many companies became detached from their underlying earnings potential. Beneath the surface of this prosperity lay growing cracks, excessive speculation, uneven wealth distribution, and a fragile banking system. Then came Black Thursday, October 24, 1929. A surge of selling hit the market, overwhelming the system. Over the next few days, despite attempts by leading bankers to stem the tide, the market continued its precipitous decline. Black Monday, October 28, saw the Dow fall by 13%, followed by Black Tuesday, October 29, with another 12% drop. The Wall Street crash wiped out billions of dollars in investor wealth, leading to widespread bankruptcies and foreclosures. This was not merely a market correction, it was the trigger for the Great Depression. As chronicled by Kenneth Galbraith in The Great Crash, 1929, the crash exposed deep structural flaws in the global financial system. It ushered in a decade of economic hardship, mass unemployment, and profound social upheaval, fundamentally reshaping the role of government in regulating markets. Number 1. The dot-com bubble, 1995-2000. Our final and arguably most impactful bubble brings us into the modern era to the dawn of the Internet age. The 1990s witnessed the explosion of the World Wide Web, promising to revolutionize commerce, communication, and every aspect of human life. Investors, eager to capitalize on this paradigm shift, poured money into Internet-related companies, many of which had no clear path to profitability or even revenue. As detailed by financial journalist Charles R. Morris in The $1 Trillion Meltdown, O NASDAQ Composite Index, fortemente ponderado com ações de tecnologia, disparou de fechar acima de 1.000 em 17 de julho de 95 para mais de 5.000 em março de 2000. Companies with little more than a .com suffix in their name and often vague business plans commanded exorbitant valuations. Analysts and venture capitalists fueled the hype, coining new metrics for success that often ignored traditional profitability. Vast sums were spent on advertising, brand building, and infrastructure, often without a sustainable business model. The belief was that this time is different, that traditional economic rules no longer applied to the new internet economy. But the fundamentals eventually reasserted themselves. In March 2000, the bubble began to burst. O NASDAQ, tendo atingido o pico de 5.132 caiu para 1.608,49 em outubro de 2002, uma perda impressionante de 78%. Aproximadamente 1.755 trilhões de dólares em valor de mercado evaporaram. Companies like Pets.com, Webvan, and many others, once valued in the billions, went bankrupt. Thousands of tech workers lost their jobs, and investor confidence was severely shaken. According to economic historian Carmen Reinhardt, in This Time is Different, 8 Centuries of Financial Folly, the dot-com bubble shared a striking similarity with past manias. The conviction that new technologies fundamentally alter the rules of economics. The enduring pattern. From tulip bulbs to internet stocks, these 5 bubbles, separated by centuries, share a common, unsettling pattern. They are not defined by the asset being traded, but by the overwhelming belief that this time is different. The conviction that a new technology, a new market, or a new economic paradigm has somehow rendered the fundamental laws of supply, demand, and intrinsic value obsolete. But history, in its relentless cycle, reminds us that while the assets change, human psychology, with its twin drivers of greed and fear, remains remarkably constant. Understanding these past follies isn't about predicting the future. It's about recognizing the warning signs, the echoes of euphoria, and the inevitable return to economic reality. What historical economic event or financial phenomenon would you like us to explore next on Money and Empires? Share your ideas in the comments below. If you found this deep dive into history's greatest financial bubbles insightful, please like this video, share it with others, and subscribe to Money and Empires for more explorations into the forces that shape our world.